with Punita Kumar Sinha to understand which way the markets what should exactly be markets focusing on. And Devina Mehra also joins us. Now we've got, we've got a very special show, and I'm feeling entirely honored that I'm in the middle of two lovely ladies. It's my lucky day, that's what I can say. Thank you so much, Devina and Punita, for honoring me with your presence at the same time on the channel.
Great, except that you're a little late. Last week was Women's Week.
We are celebrating it for the entire year. That is what we plan to do on ETNR this year.
Great.
I hope so, Nikunj. Hi, Punita.
Hi, Devina.
Good, I'm making old friends also meet today. So I'm doing all good things. But the issue,
that's certainly after a long time.
But the issue why we are connecting today is not a good cause. It is what is happening in the world. So Devina, break it for our viewers. What it means for an Indian investor in simple terms. Yeah.
I lost your audio, Nikunj.
No,
I could see you were talking.
Just a very simple question, Devina, that break it for our viewers, what it means for them, for our Indian viewers.
For the banking turmoil, because I missed part of your question. So, okay. So, of course, see, bank runs are essentially confidence things because all banks run only on confidence, because if all or most depositors come to get their money back, no bank in the world can pay it back. So that is the basis. Of course, as far as the Silicon Valley Bank, the SVB is concerned, they had a lot of issues with their balance sheet. And this time the banking crisis didn't really start with credit. I mean, normally we think that banking crisis means that the banks had made bad loans. But in this particular case, it was not that. It was that the interest rates went up very rapidly. And in fact, SVB had not made loans or credit to that extent. They had invested too much and invested in long dated securities which were not so liquid, and that created the problem. Of course, that was backstopped by the regulators by saying that deposits not just up to $250,000, but the entire amount will be insured. Credit Suisse, of course, I mean, a little flippantly, I had tweeted a couple of days ago that you can't have a financial crisis where Credit Suisse is not part of it. So they have been involved in a whole lot of scandals over time, from laundering money to breaking sanctions, and they are there almost every time. But then they are a systemically important bank, and again, the Swiss regulators have said that they will provide all the liquidity that is required. So as of now, the issue has been contained, but of course, in financial markets, you don't know whether there are some cockroaches or skeletons hiding elsewhere. So let us wait and watch on that. As far as India is concerned, there is a little direct impact, because even, in fact, something as big as the financial crisis of 2008-9 had limited direct impact on India, other than the fact that the world growth slowed, and that was a different thing altogether. But there was no contagion as such, and that was a much more widespread problem. So, I mean, Indian markets directly, I don't see a big issue. Ultimately, once this plays out, maybe the impact on the markets may well be positive, because what the markets now are banking on is that because of all these issues, Fed will back off somewhat on the rate hiking. In fact, many houses were even predicting that they will stop raising altogether. I'm not quite in that camp, but definitely the highest or the terminal rate Fed will go to might come down. So, and as we all know, that as interest rates don't go up as much, then that is a positive for the market, because then the cost of capital doesn't go up that much. So, a lot of moving parts.
Okay, Punita, so let's take the conversation forward from where Devina left, because I'm certain that you will agree with what she's flagged off. Now what happens? If one looks at the commodity prices and the 10-year bond yields, they've already reversed. In some cases, they have collapsed. The worry in the world was inflation, and the worry in the world is still inflation. But if commodity prices and bond yields come down, do you think 3 months out, 6 months out, the inflation genie will be back in the bottle?
So first of all, I agree with Devina that the impact on India is not very direct, other than, of course, our sources of capital include foreign capital. So the foreign capital is going to become a lot more risk averse in general. Now the point about inflation, I wasn't seeing signs of recession in the US earlier, but with this kind of risk aversion coming in, I think there is now genuinely a fear of recession that even I'm beginning to get a little bit worried about as to what this means for consumers and consumer discretionary. So yes, inflation could get tamed after some time, but my view is that inflation in the US isn't all demand led. There is a lot of supply side issues that have caused inflation, and those are not going to get fixed whether we whether commodity prices come down or whether Fed reduces rates, etc. So those issues will still remain, and that requires a more structural change. So I still think inflation could be an issue for some more time to come.
Now, Punita, the long-term fundamentals for Indian economy are great. India will not get impacted. That is something which I guess is easy to establish and easy to understand. But typically when you see a environment like what we currently are experiencing, it leads to serious amount of price dislocation, serious amount of repricing of terminal value. Do you think, Punita, we are in for that kind of a serious dislocation in next days, weeks or months?
Well, we've had some serious dislocation, particularly in the US regional banks and the banking sector. Even the systemically important banks have seen their share prices completely collapse. And that might continue for some more time. But I think if the stock prices come down further, I also expect that, as Devina said, that the Fed may change its policy stance from being very tight on liquidity and on interest rates to being more back to a little bit more of an easier stance, and we may not see rate hikes, which markets might like. So if markets collapse further in terms of stock prices, particularly of the banking sector, and the valuations will become a little bit more attractive, and then markets will start looking ahead, potentially if the Fed rate hikes stall. So there could be, while it's going to be a very volatile environment, there will be trading opportunities, I think, in this environment to make money.
Devina, whenever the dust will settle down, I'm asking very basic questions. Whenever the dust will settle down for Indian markets, which set of stocks or which themes will emerge as clear winners? Because every time a shakeout happens, it leads to a new leadership.
I don't think, first of all, there's going to be a big shakeout in the Indian market because the dislocation is not really there in the Indian market, and our list of stocks that we like has not changed very dramatically. Of course, next month we look at a quarterly rebalance, so maybe something new will emerge. But as of now, we are pretty much sticking to some of the things which I have spoken about in the past, that after being like kind of zero weight on banks, we actually went to market weight on banks now, what, about 9 months ago, and that has done well for us. So that we still continue. Capital goods, we continue to be overweight, but of course, that story has been playing out for us for a year and a half. So, I mean, while it still looks like an outperformed sector, it is no longer, that big room to go up that was there. A lot of it has been filled by stocks going up 2-3 times. So we've added, as I said last time, some auto components, some pharma. So that pretty much remains the thing. I mean, I do not see yet the consumption theme playing out well. So while you are saying that everything is looking good for the Indian economy, actually there is like two categories in the Indian economy, which is the creamy layer is doing well. So which is why you hear all these things of waiting lists for luxury cars and hotels, the high-end hotels being full and so on and so forth. On the other hand, you have 80 crore Indians needing free food. Unemployment being still extraordinarily high, especially for young people, and more so if you add the disguised unemployment, where people have been shown as moving back into agriculture. So there are a lot of things like that. So, for example, either on the durables or on the FMCG, with one or two exceptions, I think those still don't look great. Of course, with the rates going up, the rate sensitives also, you have to be little careful, like real estate and so on. Refineries, oil, that also doesn't look particularly great. So there are pockets which look fine, and ultimately it is also a bottom up thing. So sometimes, like, we end up being a little overweight, let's say in textiles or chemicals, but those are bottom up picks rather than sectoral calls.
Let's take the clock back and talk about your portfolio positioning on 1st of Jan versus 15th of March. And we've seen a lot. We've seen the Adani issue. Then we've seen a change in global narrative towards inflation, and now financial issues with banks. How has your portfolio positioning changed? And are you looking at changing your positioning in a meaningful manner because the world around us has changed?
Is that for
That's
Devina
right.
or me?
That's right, Punita.
Okay. So, well, I think one of the things that I was concerned about on January 1st was valuations of the Indian market. And it looked like India could underperform, and India has indeed underperformed a lot of the other emerging markets. My view is now that with this correction in the US, the Indian stocks that are, like the banking stocks that you were showing, Nikunj, have also corrected when there's really been no real significant reason for some of the Indian banking stocks also to fall. So the valuations of the banking sector and some of the other sectors where there's been price dislocation actually becomes a little bit more appealing, and emerging markets as an asset class obviously look even more attractive as compared to the US. So that thesis is looking a bit more strong than it did on January 1, that emerging markets could indeed outperform. And I think if commodity prices indeed fall and there is now more signs of a recession likely to happen in the US and the Fed rate hikes perhaps not happening, that would change also that the interest sensitives could look attractive. Potentially, autos, if commodity prices fall, would start looking more attractive. So I think the sectoral shift will happen on the margin as well. And I think globally, of course, risk aversion is rising because people are really now afraid. They don't know where to put their money, right? Because at least in the US now, you really don't know where to put your money because bank deposits are as risky as any other asset class. So at some point, money market funds, equities, and listed instruments might become a safer place to park your money because you know that you will get some value back, whereas in the bank deposits, you could get nothing back. So there could be shift in asset classes, and some money could come out of the banking sector in the US and go back into other asset classes.
Devina, ultimately we are trying to define the terminal value based on interest rates. Interest rates, sooner than later, they have to come down. Either they're nearing their peak or they will peak out very soon. If that is the construct, what happens to the sectoral outperformance and underperformance if interest rates a year from now, 6 months from now, either they will be lower or they will definitely top out?
No, they're not. I mean, I don't think in India you have seen the end of the rate tightening, and you should not, because inflation still remains very high, especially if you look at core inflation. So a couple of months of that moderation in inflation you saw was almost all led by food and things like vegetables. So that has nothing really to do with the interest rate policy. So I think that way RBI has a hard problem because the inflation has not come down and growth is a serious concern in India. And unlike the US, where there are plentiful jobs, here the labor market is also an issue because unemployment, especially unemployment for the youth, is high. And I was just smiling at your terminal value calculations because I am really not a big fan of, I mean, I have done a lot of DCF analysis. I have gone into a lot of nuances of DCF, but if you really look at it, all cash flow projections assume for every company. I mean, barring a company which is currently making a loss, they all assume that it will continue to make profits and that profit will increase every year. But actually, very few companies, you'd be surprised at how few that number is. If you look at 15 years, 20 years, that a company which shows profit growth every year is like a needle in a haystack. So, so I mean, who knows what interest rates would be 5 years from now? I mean, that's a very difficult call to make. But on the other hand, I don't think Fed also will stop hiking very quickly, because inflation again has not been tamed there. What you got was a moderation in a lot of the low hanging fruit, like housing and so on. But again, if you look at core services, there the inflation still appears high. And from these levels, even if you look at historically, inflation doesn't come down in like 3 months or 6 months. It takes much longer than that. And Fed again cannot really afford to signal that they have taken their eyes off the ball and letting inflation run. So it's a hard time to be a central banker. And I don't think we can really pitch that because interest rates will come down, that is the reason to buy the stocks, because we are not there in the cycle yet. But there are enough other reasons why the stock market might look attractive.
Let's wrap it up with one question each. I'll start with Punita. Punita, for next 3 years, for an equity investor, what to your mind is the possibility and probability of a return? 10%, 15%, more than 15%?
You're talking CAGR or
CAGR,
absolute
CAGR, 10, 15%, 3 years, so then it is better to put money in FDs.
It's a very hard thing to say, given that we are in so much turmoil. So it's the toughest time to ask this question. But I think from here, if you're looking out 3 years, where the valuations are today, you could probably get a CAGR of about 8% to 10%, I would say.
Then why should one invest in equities at all if fixed income is giving me 8 to 9% risk-free?
Well, as I said, at least in the US, you don't get that kind of return, and bank deposits are risky by itself, as you've seen. So, I mean, in India too, I think one has to be diversified, because you can't have all your money or all your eggs in one basket.
Devina, for an Indian viewer, and we're going to wrap it up very quickly, what to your mind for next 3 years should be the projected return for equities?
Well, Nikunj, I never give projected nifty targets or returns, but I can tell you that we are, the 40-year return has been 15%. We are still not above the trend line. So the risk of a crash is limited. And still, I think the risk would be in not being invested rather than in being invested. So sitting it out is more risky than being in the market, because at some point you will miss out on a big up move. That is rather than the comparative risk of a crash from here on. I mean, there might be some downside, but I don't see a big crash from today's levels.
Devina, Punita, thank you for joining us. And must say that it's just been so nice to have both of you at the same time on the same channel, and really look forward to having more such engagements.
Thanks, Nikunj.
Thank you.
All right, now we've got markets which have made a nice comeback, and that's the reason why there's a smile on my face.